Welcome, everybody, to our next keynote presentation here at the SNN Network Summer Virtual Event 2021. I'm your host, Robert Kraft, and I'm really excited to introduce to you our next speaker. It is Ben Claremon. He is the Principal and Portfolio Manager at Cove Street Capital. And the title of his presentation today is 10 Investing Lessons from 10 Years. I've known Ben for a long time, and he's one of the best investing minds in the game. So much so that we actually partnered up on a new show that's coming to the SNN Podcast Network titled Compounders, the Anatomy of a Multi-Bagger. So with that, Ben, please take it away.
Bobby, thanks so much for having me here. I'm excited to be speaking in front of everybody. Let's start with the must-have, which is a safe harbor. We're not going to be talking about any securities that we invest in, but please read this if you're interested in our safe harbor. Just a little bit about myself before we get into the presentation itself. So I've been at Cove Street since 2011, hence the 10-year reference in the title. I'm a partner and a portfolio manager here. I run our mid-cap strategy, which is called Small Cap Plus. I worked on the buy side in New York prior to going to business school. Back in the day, if you were familiar at all with the blogosphere, I ran a blog called The Inoculated Investor. And as Bobby mentioned, I'm now the host of Compounders, the Anatomy of a Multi-Bagger, which we will talk a little more about later in our shameless plug at the end. So I like to give people an overview of the presentation so that you kind of know where we're going. The simple goal here is to walk through my personal journey to help anyone who's listening avoid making the same mistakes. So that's the overarching goal. We're going to start off with the stories, or two stories actually, about how to and how not to get a job in investment management, just to personalize this journey a little, even a little more. And then we'll move into the 10 lessons learned over the last decade. You're going to see that it's an eclectic mix of lessons. It's going to be about the art of investing, about the business side of investment management, and about the role of investors in the market. And then we're going to close with some key takeaways. And I'm going to share my contact info if you have any comments or feedback. And then again, we'll talk about the new podcast that Bobby and I are working on. So let's start with the first thing, which is how to get one way to get a job in investment management. And so let's take it back to 2011. It's 2011, and I was about to graduate from business school. And the investment world was really still thawing from the financial crisis. And it was really hard to find opportunities. And also, anyone who's been to business school knows that it's kind of hard to balance schoolwork and networking and job search and trying to be an investor all at the same time. So, it was an all-encompassing experience. I also, layering on another thing that was on my plate, I started the blog, The Inoculated Investor, and I'll talk a little bit about why this is important. The goal was to stay in the game and get my name out there while I was in business school. But I knew I needed some unique content to get people to travel to my site, and so that I could become kind of well known in the value investing blogosphere. And it was in 2009, and I was at the Berkshire meeting, and I decided to take notes from the meeting. And I made the crazy decision to try to take down every word that Buffett and Munger said. And that started a journey where for three straight years, I took notes for 6 hours and then probably did 10 plus hours of editing from the meeting. And so for anyone who wasn't going to the meetings those days, they weren't live streamed. There was no Capital IQ transcript. There was no Bloomberg transcript. You really had to be there in order to have any sense of what Buffett and Munger said. And given that I'm a true value investor and that I know how important Buffett and Munger are to the value investing community, I thought it was a little bit of a shame that there weren't any transcripts, or there wasn't any way for you to know what they said unless you were there. And so I took it upon myself to provide that service to the value investing community and the investing community at large. And it was through the blog that I was connected with Cove Street's founder, Jeff Bronchick. It all started with an act of kindness. Someone who followed my blog, who I'd actually never spoken to, knew that I was looking for a job and contacted Jeff and said, "Hey, I know you're looking for somebody. You have to meet anybody who's willing to sit there for 6 hours to take notes." The rest is history. I've been here for 10 years, and it's been an incredible ride, an incredible learning experience, which I'm going to share in a moment. But the lesson here, I think, is to be successful, sometimes you have to be a little bit nutty. And what that means is that to distinguish yourself, sometimes you have to do something that very few other people are willing to do. So after that very exciting story and promotional story about my background, I now need to temper that with a story about how not to get a job in investment management. And so through the blog, I was actually connected with Oaktree Capital's founder, Howard Marks. He gave me an advanced copy of his book, The Most Important Thing, and I actually reviewed it for the blog. So I developed a relationship with Howard Marks, and it was, for someone who was interested in investing and trying to get a job in investment management, it was a very good relationship. But my goal from the beginning was to be an equity research analyst. And anyone who's familiar with Oaktree knows that Oaktree specialty is not equity investing. And so I'm not saying Howard Marks offered me a job, but he offered to help me. And I couldn't figure out how to make that work because I was so focused on equity investing that I didn't have the purview to say, well, I mean, this seems like a really interesting opportunity that I should pursue. And so while I wouldn't trade my experiences at Cove Street for anything, I think the lesson here is that as you're thinking about your career or an investment, don't be myopic or short-sighted. There are many, many paths to success. You'll probably change careers multiple times in your life, and you should be open to different opportunities that fall into your lap. And the more specific lesson is, if Howard Marks offers to help you, take him up on it. So before we start the lesson part, just a few caveats. I'm a value investor, so I always talk both sides of both sides of the book. So these are the lessons from the first decade of my investing career at Cove Street. And so I anticipate that I'm going to learn a bunch of new lessons over the next decade. And honestly, I may have to rethink or unlearn some of the lessons that I'm going to go through over the next few slides. Think of this as kind of a mid-career status report where I'm just kind of giving people a sense of the most important takeaways I've had so far. And honestly, I hope to look back in 10 years and cringe and say, I can't believe I actually said in public that this was something I learned. The other thing to note is I'm unabashedly a value investor. So some of these takeaways, are through that lens. And so they may not necessarily resonate with people who don't, share that framework. And of course, other people will have had different experiences in their careers. The goal here is for this to be thought-provoking. These aren't rules. There are no rules in investing, really. And personally, success in this keynote will be that at least one lesson will resonate with everybody who's listening. So let's start with number one, and it's number one because it's been the most revolutionary in my career. And so the lesson is, cheap often means cheap for a reason. And so it helps to tell a little story to give some context for what that means. So the first stock I ever pitched to Cove Street's founder, Jeff Bronchick, was a company called Sterling Construction. My early education as an investor came from the Ben Graham School of Value Investing. And according to Ben Graham's world, a stock trading at less than tangible book value was great. That's what you were looking for. But I never really asked the questions that I ask now. For example, is this company getting more valuable every day? Or does this stock deserve to trade at a discount because it's unable to generate returns above its cost of capital? And these are things that I ask myself every day now, but back then I was more focused on the valuation part. And so the reason why this story is interesting is because the stock is still public and it's just materially underperformed. The Russell 2000 since 2011. This is what's known as a terrible investment. Thankfully, Jeff still hired me, even though I pitched this to him. But it's emblematic of, the story is emblematic of so many of the companies and situations that I've looked at over the last decade. And the lesson here is that, and this is my personal focus, is that if you're investing in mediocre businesses, you have to be right twice, which means that you have to be right when you buy it and you have to be right when you sell it, because time isn't your friend. You have to time the buy right, because if you don't, it goes down more. You may be really nervous about buying more on the way down. On the flip side, when it gets to fair value or somewhere near fair value, you have to sell it, and you have to be right about fair value, because otherwise you might get a round tripper. This is not a stock we own, by the way. We've never owned Sterling. It's just it's a good story about, you know, the early days of my investing career. On the other hand, when you talk about compounders, you just need to be right once. You need to buy it right, and you need to hold on. You need to have the fortitude to be able to hold through what the market throws at you. And the other thing that's great about compounders and businesses that are getting more valuable every day is that the intellectual capital you build can last throughout cycles. It's not like you buy one of these businesses cheap and then the cycle turns and you have to sell it. No, these are businesses you can hold forever, and you continue to compound your knowledge on the business. So the next lesson would be number one, if the first lesson about cheapness and not focusing on cheap securities wasn't really like adopting a new investment philosophy for me personally. But the second lesson is understanding people is underrated by most investors, but it's extremely important. So as I mentioned, you know, coming from the Ben Graham School of Net Nets, you know, value and valuation were what mattered. Since then, I've really internalized Buffett's quotes about the importance of paying attention to people. And I've learned the hard way the cost of partnering with the wrong people. And all of these lessons I've learned and all of these things that I've added to my personal investment process are captured in a presentation that I give every year to the Ben Graham School students at UCLA. That the Ben Graham School is the undergraduate value investing program within the UCLA economics department. And the takeaway I leave the students with every year is that assessing people within the investing framework is really hard. And then I pull up a slide of an ostrich and I say, don't be an ostrich. Don't put your head in the sand. Don't ignore the people aspect, because it's really important. And just because it's hard to assess people accurately, you know, doesn't mean you shouldn't do it. And you have to be willing to accept that you're never going to be 100% sure. So the solution that I've created personally after trials and tribulations in this world is that you need to develop a comprehensive checklist that you always go through when evaluating management. And you use that checklist to develop a thesis. Is a management a friend, or is a management a foe? And then you update it over time based on new information and new data. And so we do that for all of our investments at Cove Street, and it is a labor of love, for sure. It is a lot of work, but I think it really gives us a much more holistic view of the company we're investing in. And so if anyone's interested in seeing this checklist or seeing the presentation I give, just please contact me after the presentation. So lesson number 3, capital allocation is a required skill set, but many CEOs don't have a North Star. So let's step back and think about the typical career path for a CEO. He or she could be a salesperson or a plant manager or even the CFO. But where do these people specifically learn about capital allocation? How do they develop a disciplined framework for capital allocation? Maybe these people are great leaders or accountants or operators or even motivators, but have they read Buffett's letters, or have they read Thorndike's The Outsiders? Have they worked in private equity, which, in general, I think gives people a pretty good framework for investing and for capital allocation. Nothing against business school. Go Bruins. But, I didn't learn anything about capital allocation in business school. So where is it taught? How do you learn this stuff? And the reason why this is important is because if you're the CEO of a company for a decade or so, you're going to reinvest a huge percentage of the company's capital base, in M&A or dividends or buybacks. Maybe you're thinking about divestitures. Maybe you need to ask yourself the question, should this be a public company at all, right? Should this be a private company? And so these are key decisions that I think a lot of companies, especially smaller ones, often need some help with. And so after 10 years of living in small and micro world and now focusing a little more on the SMID side, but living in the smaller company side of the universe, the takeaway is that you have to be a suggestivist. And so that's a little bit different from an activist. A suggestivist is an active investor who partners with a company, for the benefit of everyone. On the other hand, an activist, I think in general, not to denigrate any activists, because we've done our own fair share of activism, but an activist is someone who comes into a situation looking to cause change, as opposed to looking to partner with management to help them get better when it comes to governance, compensation, and capital allocation. So I think, as at Cove Street, we are unabashedly suggestivists, and we look at it as, if we come into a new investment, we want to establish a productive dialogue with management so that we have a seat at the table, when there are questions about capital allocation or governance come up. This next lesson, I think, is the #1 candidate for lessons that I might unlearn over time. And it's that multiples and valuations can expand to levels you never thought possible. The last 10 years, or maybe even starting with the financial crisis from until now, maybe this period of time is an anomaly, and we're going to look back on it like the late 90s and think, like, what in the world were people thinking in terms of what they were willing to pay for businesses? And as a value investor, I hope and pray that I unlearn this lesson. But the fact remains that we've seen meaningful multiple expansion in what we would call the Buffett stocks that are compounders, stocks that are getting more valuable every day, stocks with moats, those businesses that kind of long-term value investors really would like to own at reasonable prices. And so the corollary to those higher multiples is that as rates have come down, investors have started to use a lower and lower cost of capital for their companies, which allows people to pay just about any price. If you're valuing something on a DCF and you're using a 2% risk, 2% cost of capital, yeah, that can justify purchasing just about anything. And so, looking kind of like a value investing dinosaur, over this period of time, we have stuck we've stuck to our guns, and Cove Street, we hard code, which means that we can't change the risk-free rate below 5%. In hindsight, as rates have come way down, that looks really silly, and it makes it so that our DCFs look, very conservative relative to other people's. And it's been a mistake not to pay up for great businesses, and it's been a mistake to not underwrite multiples that are way higher than historical averages. But we think that there's a fair amount of intellectual backing here for being a little more judicious in what the multiples and that we're willing to pay, and the discount rates we're willing to use as we're underwriting companies. For example, Research Affiliates, I think in 2017 or 18, came out with a really interesting piece that went through history and said and looked at situations in which there were high yields and low yields, and like what was the corresponding valuations in stock markets over that time. And in reality, prior to the current period, periods of low yields actually led to lower valuations than in the past, meaning that in the current environment, people are justifying low yields for putting high valuations in stocks. But in the past, it's actually been the opposite. Low yields would imply low growth and thus lower valuations. So I think we should be clear that this period has been a historical anomaly, but it doesn't mean it hasn't been painful for us. So the takeaway is that you kind of have to be balanced and flexible when it comes to how you value companies. And you have to stick to your guns to some degree and be a little stubborn, but you have to add some flexibility on top of that. And my personal takeaway is, as a portfolio manager, is that it's okay if some percentage of the portfolio looks expensive, because you probably don't want an entire portfolio that looks like it's extremely expensive and it requires a lot of things to go right for you to make money. But as long as you have some diversification, it's okay if a percentage of the portfolio looks optically expensive if you believe in the long-term growth prospects. The next lesson is not really about investing, but it's about the business of investment management and the skill set required to be an investor. And so being an analyst and a portfolio manager require different skill sets. So if you think about an analyst, a good analyst, my sense is a good analyst does deep due diligence, comes to thoughtful conclusions, and is a good communicator. On the other hand, being a good PM requires all of the above, plus the ability to manage your emotions and biases. As an analyst, you have a safety blanket, who is the portfolio manager. But as a portfolio manager, the buck stops with you, right? There is no one to, to give you cover if you have a poor idea or make a bad investment. And so in that, as a PM, the behavioral biases become more and more salient and impactful. And in fact, you develop behavioral biases you didn't even know existed. And so to me, awareness is the first step. You have to understand your own tendencies. And from there, I think you have to make sure that your process is specifically designed to mitigate biases. And so how do you do that? From our perspective, and I'm going to steal a little bit from the technology world, I'm talking about first principles in the sense that take your process, rip it down to its studs, and like, what is the first principle? The first principle is that your process should help you make decisions better and mitigate your own personal biases. And so what are some examples of how we do that? So the first thing that happens is that the analysts, all of us, even before we were portfolio managers, we had to put on the portfolio manager hat early in our careers, which means that any idea that we worked on, we had to weigh in as if we were the portfolio manager. Should we own it? Yes or no? What size should we own it in? And if you don't want to own it here, where would you own it? Like that makes you think not like an analyst, but more so like a portfolio manager. We also record our decisions and our investment premises, which means that it's July 2021, it's August 2021. What are we thinking now? What are we thinking about this stock? What do we think it's worth? What do we think, what do we think it could be worth in 3 years? What do we think about the business? Write that down, put it in, what are the key variables? Put that in our spreadsheet, and then go through over time so that you can go back if you make a mistake or if you're successful and see whether your process was right or wrong, or whether you just missed something. It just gives you the ability to go back and see what you were thinking and understand where you can get better in terms of your process. Also, some people like to write long investor letters. Maybe that's just me, but honestly, I think writing your ideas down, both in terms of like the specific stocks, but also like, just your investment philosophy and principles, and reinforcing that over and over again, I think that can be helpful. We also team tackle our ideas, which means that we always have 2 longs and 1 short on every idea. And what that does is it creates a devil's advocate whose job it is to quote unquote kill the idea. And what it is mostly it's just a governor on how fast your process can move, and it limits the number of ideas that get to the final stage of our investment process. And as a portfolio manager, as an analyst, you can't be afraid to ask for feedback. You can't be an expert on everything, and if you can find people who know more than you do, you have to be willing to leverage their expertise. And then within that, you have to actively seek disconfirming information. And then I think this is key. You have to be willing to act on it. So let's say you have an investment that you have a premise on, and some information you get completely refutes that premise. There's a tendency, and one of the biases, commitment, consistency, status quo bias, inertia, all of these things would tell you that, it's not a big deal. Don't overreact. Just stick with the position. But I think when you get disconfirming information, you have to willingly look at it and say, is this actionable? Does this mean that we shouldn't own the security? Moving on to lesson 6, industry structure is something you should pay a lot of attention to. Here's a simple investing idea that I don't think gets talked about quite enough. Why wouldn't you start an investment search for a new idea with an industry that has duopolistic or oligopolistic characteristics? What you're going to find is you're going to find higher margins, better returns on capital, and more rational competitive behavior. In situations like this, unless technology is changing really fast, the status quo could be fine. As long as the company that you're looking at maintains its relative share in the market, it could be a really good investment. And you should also, on the flip side, as an investor, you should make note of any industries where there's significant consolidation occurring or where fragmentation is being reduced. Because I think in my history, I've seen that the market can be slow to recognize pricing power that's accruing to the incumbents. So some of you might be saying, yeah, duh, like of course you want to start with good businesses in a good industry. But just think about how many investors get trapped in complex companies and unattractive industries. And honestly, like I just don't hear that many people starting here where like, let's start where in an industry that has consolidated to the degree that the incumbents have a lot of pricing power and a lot of stability. And so I'll steal a quote from Charlie Munger, who says that you should fish where the fish are. And if good investing starts with avoiding mistakes, why would you fish in a mediocre pond? Moving to number 7, this is one of the most painful lessons I've ever learned, and it stuck with me more than I think any of them, in terms of just being born from a mistake. So invest in a business that can take a punch and doesn't have binary risks. So the biggest investment mistake I've ever made was investing in a business that could not take a punch. So what is a business that can take a punch? A business that can take a punch is one in which if they lose a major customer, or one of their end markets is struggling, or one of the, a geography isn't doing well, it doesn't pose an existential risk to the entire company. It's an annoyance. Maybe the stock goes down, maybe the analyst community gets upset, but it doesn't, investors don't lose all of their money. And so I now look for businesses that have the resiliency and the breadth and the scale so that they don't, a single punch isn't gonna, knock them out. Unfortunately, if you're living in the smaller cap universe, these risks, binary risks and, not being able to take a punch risks are kind of endemic to small companies. And that's due to either customer, geographic, or end market concentration, businesses with less scale and fewer revenue streams. And then often management may not be sophisticated enough to deal with some real issues that are going on within the business. So a lot of this stems from one investment I'll never forget. I'm not going to name the company to protect the innocent or the guilty, as it were. But this is a company that lost a major customer. They had a binary risk, and we knew about it, and we underwrote their investment despite that. And after losing that customer, the company levered up to do M&A to replace the lost business. There's always this desire, you have to do something to replace that lost business. And this company literally could not handle the deal complexity. And, 3 or 4 years later, the company eventually went bankrupt. I learned 2 lessons here. One, again, about investing in businesses that don't have binary risk and can take a punch, but also a great lesson about assessing people and their capacity and capability to really handle very complex situations. So I'll throw out there the idea that a cheap valuation is not enough to protect you in a company that has end customer concentration, or has some kind of binary risk where they can lose a contract and the whole business is in flux. I don't think it's worth the potential upside to underwrite that the fact that this is not that maybe it doesn't work out the way that you expected. So if the first 2 rules about investing are don't lose money, why would you bother with situations with this much risk? Instead, why wouldn't you invest in scaled, well-run businesses that actually can benefit when there's turmoil in their markets? This one is specifically about the business of investment management. And that's the takeaway here, and the lesson here is that investment managers need to establish a brand. So when I first started in this industry, I had this fantasy about what it was like to be an investment professional. And I really thought that it was quiet reading and 100% focus on investing. Then there's the reality, after 10 years, which you realize, and if you come to our office any day of the week, you'll see that everyone has to wear a lot of hats, and not all of those hats have to do with investing. For the business, especially when you're a boutique asset manager, for the business to thrive, everyone has to spend some time marketing and fundraising and building the brand. And so I think it's important, especially for people who are just starting in their careers or starting a firm, or thinking about how to make their firm really successful. I think you need to start a brand and build brand equity as early on as possible. And within that, you have to find a way to stand out from the crowd. Because honestly, especially within the value investing community, everybody runs concentrated and everyone has a long-term orientation and everyone's doing deep diligence, but it's really not enough. It's not enough to distinguish you. And I don't think it's enough for you to be able to outperform. And the other thing is, everyone is calling on the same capital allocators. Who doesn't want money from Harvard or Yale? And something called the Lake Wobegon effect would suggest that all investors think they're special or above average, and that everyone thinks that they deserve money from the top endowments. But if you can't answer the question 6 months after this meeting, what will this capital allocator remember about me or my firm? Then I don't think you have a brand. And it should, whatever you decide your brand is, or your edge, or your, whatever distinguishes you, it should be authentic and it should be differentiated. But I think as a firm, and even as an analyst and as a portfolio manager, you have to establish what that brand is. And so how do you do that? Well, you could maybe launch a game-changing podcast, which I'm trying to do. You can put out white papers. You can put out stock pitches that investors find interesting. You can be amazing on Twitter, which a lot of people have, I think, leveraged into a nice career in investment management. Or you could do, you can be involved in epic keynote presentations like this one. Moving on from the business of investment management, position sizing is something that I just don't see people talking about very much. And I think one of the reasons is it's a lot more art than science. Unless you run a quant fund, position sizing is just kind of a squishy thing. Like what position size should a specific position start at? What is your max? But I do think that this is, while it's really underappreciated as a topic of conversation in the investment community, it's a really important skill. So taking a step back, what should you overweight? We have 3 pillars of our investment process at Cove Street: business, value, and people. So which one of those should you be overweighting? Because I think in most cases, there's a trade-off between business and value. You either pay up for a good business or you pay a lower price for a mediocre business. So given that, should your biggest positions be in the most undervalued stocks or best businesses? So another painful lesson that I've learned is that if you rank the companies and position weight them based on the biggest discount to intrinsic value, you start to be overexposed to value traps, and the worst businesses become the largest positions. On the other hand, if you overweight compounders, first thing is you sleep better at night, and the second thing is you'll benefit from, in an outside manner, when companies perform better than what people were expecting. So I'm not going to suggest that I have anything resembling a perfect formula for whether something should be a 2.5% or 5% or a 10% position. All I'm suggesting is that everyone and every firm should be intentional and apply a consistent framework when it comes to position sizing. And I think inevitably that's going to be a blend of qualitative and quantitative factors, as opposed to, some spectrum where, it's 100% quantitative or 100% qualitative. I think a blend makes sense. And in my humble opinion, you want to invest more where time is your friend. And so that suggests better businesses that are compounding and getting more valuable every day. So moving on to the last lesson. This is something that I've recently incorporated, but because I don't think I had the language for it until recently. And it's about understanding the degree of difficulty in an investment, and then of course layering on base rates of success. So I'm stealing the idea of degree of difficulty from Adam Grant's great podcast, Work-Life Balance. I didn't actually know this, but the term degree of difficulty actually comes from diving. So a judge in diving will not only judge the execution of the dive, but also how difficult it was. And so I really like this concept to apply it to investing. I've always used Buffett's too hard bin, to avoid overly complex situations. For people not familiar with that, it's this metaphorical bin that sits on your desk that when you read a 10K of a complex company that you have to read the K like 5 times to figure out what they're doing, you throw that 10K into the too hard bin and say, this is way too complex for me. There's no reason for me to spend more time here. So I've always used that. But now I also layer on this idea of degree of difficulty associated with a stock. Because I think an investment can have a high degree of difficulty and not be that complex. It can be really simple in terms of the business, but how the path to you making money can have a high degree of difficulty. And so I now ask myself and my colleagues when we're talking about ideas, how many things need to go right for you to make money? Because the more things that need to go right, the higher the degree of difficulty and the less margin for error. And so I would much rather focus on things that have a lower degree of difficulty and need fewer things to go right. And I think all good investing comes down to understanding base rates. And I'll credit, Mike Mobison for really, perpetuating and being the gospel leader when it comes to talking about base rates. So for every investment now, I sit back and I ask, what is the base rate of success for this investment? So given all of the other management teams that were trying to do a turnaround in this environment, in this industry, what do you think the base rate of success was? Was it high? Was it low? You're never going to have the full reference set. You're never going to be able to look at the last 100 companies that did this and know exactly how many were successful. But I think you should really have a sense of whether it's high or low. And then sit back and ask yourself, what is your edge in handicapping that outcome? Do you really have an edge in understanding whether or not these people are likely to be successful, or are you just, anchoring to something that management said, or something that an expert told you about the industry? And so I think if you put the base rate framework into your process, it will allow you to understand where you have an edge, where you can develop an analytical understanding that gives you, a lot of conviction, and where you are kind of at the whims of the market. And so if you're sitting back and asking yourselves, should you focus on a lower degree of difficulty, higher base rate investment, even if the upside is lower? I would say yes, because if you have an easier path to making money, and other companies have been successful in trying to do the same thing this company has done, then you reduce your risk of losing money, and most importantly, you sleep better at night. So thanks for indulging me on this journey. I'm just going to leave 5 key takeaways that I think, if you sit back and you remember this presentation in 6 months, what would I like for you to take away? And again, this is just my personal journey, and so everyone will have a different take on this. But for me, it's start focusing on better businesses as soon as possible, especially those in attractive industries, and make those your largest positions. Secondly, develop a framework to help you understand people and assess management. Third, create a process that helps mitigate your own personal behavior biases. Fourth, binary risks are not for conservative investors or those who still want to be around 10 years from now. And lastly, brand building is really important, even in investment management. So those are my 10 lessons and the takeaways. If you have any comments or questions or feedback, I'd love to hear from you. You can email me at bclaremon@covestreetcapital.com. I'm also pretty active on Twitter, so you can follow me at Inoculated Investor on Twitter. And then if you're looking for an investing related podcast to listen to, I highly recommend you try and check out Compounders, the Anatomy of Multi-Bagger. Again, this is the podcast that I've created in conjunction with Bobby Kraft. We interview public company CEOs about how they've compounded wealth over a long period of time. And I'll just give a spoiler in that our first 2 episodes have Fortune 500 CEOs on there, and so I think we've got a pretty good first season, and I hope you give it a try. And with that, I'll say thank you one more time to Bobby and SNN, and for everyone for listening.
Ben, thank you so much for joining us today. We really do appreciate it. And everybody go check out Compounders, the Anatomy of a Multi-Bagger. I guarantee you will like it. And with that, thank you.